Stop what you're doing, because if you use money, this affects you. Right now, something historic is happening. Not someday, not eventually, right now. The money system you were raised to trust is cracking in real time. Prices keep rising, debt keeps exploding, and the people in charge keep saying everything is fine. But here's the truth. No one wants to say out loud, modern money is broken. And once you understand why you'll never look at your paycheck, your savings, or your future the same way again. I'm Jaylen Brooks, and today we're breaking down the collapse no one is ready for. Stay with me, because this might be the most important video you watch this year. Let's start simple. Most people think money is backed by something real: gold, value, hard work. That used to be true. Today, money is backed by confidence and debt. Modern money is called fiat currency, which means it has value because the government says it does. That's it. No gold, no limit, no brake pedal. When governments need money, they don't earn it, they don't save it, they create it with a keyboard, a click, a number on a screen. And every time they do that, your money becomes worth less. Not because you failed, not because you didn't work hard enough, but because the system is designed this way. In the past, inflation was slower. People could save in cash and still build stability. Today, inflation moves faster than wages, faster than savings accounts, faster than most investments people understand. So holding cash feels safe, but mathematically, it is losing strength every year. This is why wealthy institutions do not sit on large piles of cash. They treat cash as a temporary position, not a long-term strategy. Before we start, hi, my name is Jaylen Brooks with Modern Money, and I would like to thank you for stopping by to build wealth with us. If you find value here, please help us by simply clicking the like and subscribe button. And before we start, know that one step in the right direction can change the rest of your life. Today, we will uncover the collapse that is happening in front of our eyes, and no one is speaking out or warning us. Here's where it gets dangerous. The entire system now runs on debt. Governments borrow money to pay old debt. Consumers borrow money to survive. Corporations borrow money to stay competitive. Debt isn't the exception anymore. It's the foundation, and the scariest part, there is no plan to pay it back, because it can't be. So what happens when the debt becomes unpayable? They print more money, lower interest rates, change the rules, which leads to more inflation, more instability, more pressure on you. This isn't a glitch, it's the end game. Pay attention to this part. Last week, Microsoft and the S&P 500 dropped more than 10 points, and most people didn't even blink. No emergency alerts, no flashing headlines, no serious explanations, just silence. Here's why that's dangerous. Microsoft isn't a weak company. SPY isn't some speculative gamble. These are cornerstones of the system. When strong, profitable, dominant companies start sliding at the same time, that's not random. That's pressure. Wall Street will tell you it's healthy pullback. They'll say it's profit taking. They'll say it's normal volatility. But here's the truth. Strong companies don't fall hard in strong economies. They fall when the future starts getting priced in. And the market is forward-looking, always.
Gold and silver prices continued to fall after an historic crash that wiped out more than $7 trillion. That's about the combined GDPs of India, Indonesia, and South Korea combined. We explore the reasons for the rout and whether this is just a sign of things to come. Live from Sydney, I'm Paul Allen. This is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Although the nomination of Kevin Warsh as Fed chair helped to spark a sell-off in precious metals, we look at how speculators in China may also have set the stage for the slide. Precious metals expert Jeffrey Christian, managing director of the CPM Group, joins us with his take on what really drove the collapse in prices. Nasdaq futures drift lower as Nvidia punctures the AI hype. CEO Jensen Huang saying investments in OpenAI might not be as large as expected.
Good morning, Paul. Well, definitely a little bit of that. I mean, the run-up that we saw in the precious metals market really steepled last week before we hit that wall. The proximate reason or explanation is the appointment of Kevin Warsh to the Fed, seen as potentially more hawkish than some of the other candidates, and also his views on the Fed's balance sheet. If he would like to reduce that, that would take take some of the liquidity that's sloshing about in the financial system out of it, and may therefore hurt some speculative activity and also boost the US dollar. So we saw the dollar strengthening a lot on Friday, and that weighed on all commodities trades, but then it sort of took on a life of its own. Those high momentum trades, and particularly gold and silver with a lot of speculative money in them, faced that big.
Now ask yourself this: if the average person understood what was really happening, would they stay calm? Of course not. Markets don't collapse from bad data. They collapse from loss of confidence. So what does Wall Street do? They soften language. They delay reality. They keep retail investors calm while institutions quietly reposition. This isn't about panic. It's about containment. Because once people realize that even the strongest names are cracking, they start asking the wrong questions, like what happens during a recession? Because here's the part no one wants to say. If Microsoft and SPY are dropping now, what happens when the economy actually turns? This is why early cracks matter. Not later, now. And this is where it gets even more uncomfortable. One of the largest bond managers on earth, PIMCO, just raised a major warning. Private credit, loans that aren't publicly traded, less transparent, harder to value, harder to exit. Christian Straka, president of PIMCO, said this: "It is not a good sign that you have all of these problems emerging in terms of loan performance at a time when the economy is about as good as it gets. If loans are already breaking, now what happens when conditions worsen? Private credit doesn't blow up loudly, it breaks quietly until it doesn't. And by the time it hits headlines, the damage is already done. If people truly understood modern money, they'd panic, they'd ask questions, they'd demand accountability, they'd stop playing the game. So instead, we're distracted. Culture wars, politics, trends, noise. Because as long as you're arguing about everything except money, the system stays intact. But here's the shift happening now. People are waking up. And once you see it, you can't unsee it. This isn't about fear, it's about awareness. Modern money punishes people who save cash, rely on wages alone, trust institutions blindly, and it rewards people who understand assets, learn financial systems, adapt early. You don't need to be rich, you need to be informed, because the rules are changing, and no one is coming to save you. Wealth is not how much cash you hold. Across the world, confidence in fiat money is weakening, and alternative assets, digital currencies, decentralized systems, and real assets. This doesn't mean everything collapses tomorrow. It means the old world is fading and a new one is forming underneath it. The people who survive transitions like this aren't the strongest. They're the ones who see it early.
Ray, you mentioned capital war. Do you believe that we are on the cusp of a capital war? So much of the market focus right now is on the president's trade and tariff agenda. We often talk about the implications of the trade war that we see unfolding. What about a capital war?
We are on the brink. That means not in, but it means we are quite close to, and it would be very easy to go over the brink into a capital war, because there are mutual fears. For example, if you were to take the conflict even over Greenland related to Europeans and the United States, there could be a fear that European holders of U.S. denominated assets could have, that they could be sanctioned in a sense. They might have a fear in one way or another. Gold is the second largest reserve currencies. I think if people were to make those who are running policies and so on were to say, they would say gold is the safest money in this kind of an environment.
Still the safest.
Yeah, it doesn't change by the day. You know, gold is up about 65% from a year ago and down about 16% from its high. And I think people make the mistake of thinking, is it going to go up and down and should I buy it? And instead, not whether it's individuals, but even more importantly, perhaps central banks or governments or sovereign wealth funds should say, what percentage of my financial assets, what percentage of my portfolio should I have in gold? And think about that percentage. And then if the price goes up and down, if it goes up too much, you sell out to get back to that number, it goes down too much, but to keep a certain percentage, because it's a very effective diversifier to other parts of the portfolio.
If this video made you think differently about money, subscribe to Modern Money. We drop weekly videos on credit, business, income, and wealth building, so you can stop guessing and start moving with confidence. And comment below, what's the one thing about money no one ever explained to you? If this video made you uncomfortable, good. That means you're paying attention. Because ignorance feels safe until it's expensive. Now listen closely. If you want more breakdowns like this, if you want to understand money, power, and what's actually happening behind the scenes, then subscribe. Not tomorrow, not later, right now. Share this with someone who still thinks the system is fine, and comment below, I see it. Because once you do, there's no going back. This is Modern Money. I'm Jaylen Brooks, and this is only the beginning. Please remember, one moment of effort becomes a lifetime of change.